In fact, multiple times on this program, we've interviewed Professor William Lazonick of UMass. And I can't remember when the last one was. Maybe one of my producers will look that up. Yeah. But in both those interviews, if we've only done two, maybe we've done three, we've covered the notion of work he has done in trying to determine what has caused the stagnation of wages for workers, broadly speaking, and what has caused the explosion in CEO pay over the past 30 years or so. And he has determined that it's really sort of, it's multiple things, but it sort of cascades from the change in the tax structure where capital gains would be taxed at a rate far less than income earned from work. And this changed the pay structure for CEOs and board of directors, wherein they would receive stock options or stocks as part of their compensation package. And this caused CEOs and board of directors to sign off on what these CEOs were doing, to run their companies in such a way that they no longer perceived their, I guess, goals to be long-term, the long-term health of a company, the long-term development of markets for a company, the long-term stability of its workforce, because their compensation was tied into short-term and mid-term gains in the price of the company's stock. And, I mean, understand that a capitalist runs a company to make money. And that doesn't necessarily mean that the company has to make money. It means that they have to make money. Now, usually those two goals are parallel. But if a CEO can make money simply by cutting his workforce, increasing profits, starving research and development, you're not going to feel the impact of that for years down the road. However, your stock will see an immediate impact from that. Further, Lazonick, last time he was on, was talking about the stock buyback as another means in which to increase the value of your stocks. You have cash reserves, you have profits. Do you plow that money back into buying new machinery, research and development, employee training? Or instead, do you go on the stock market, buy back your stock, and increase the value of the remaining stocks? And who holds those stocks? You, as the CEO and the board of directors. And therefore, you make money. It's basically, the way to think about this is like a side bet in poker in some way, or a cottage industry embedded in a larger company. I mean, it's almost as if I don't know, I guess if I owned the office that we were working in, and really my real income came from rental. So it really wouldn't matter whether or not this show succeeded or failed, as long as it kept paying the rent. I don't have to derive, I don't have to, you know, I'll get rid of all our employees here, and I'll just do a 15-minute show, and I'll just keep it as long as they pay the rent, if that's my business. It's not a perfect analogy. So when we last spoke to Lazonick, he saw great problems with the stock buybacks, and it was not always the case that a company was allowed to buy its own stock. And the reason is quite obvious. Buying a bunch of stock pushes up the value of your stock. In other words, it manipulates the price of your stock. Coincidentally, those laws were changed in 1982. Or I should say rule in this case. A regulation was changed in 1982 under, yes, the Reagan administration, the same time, same era, I guess I should say, that we had that massive drop in the capital gains taxes. David Dayen, writing in The Intercept, I'll tell you something, when you have a piece where like the words David Dayen and Bill Lazonick are in the same piece, I feel like I'm in heaven. The Securities and Exchange Commission has admitted it has no ability to enforce the main rule intended to prevent market manipulation when companies buy back their own stock, and no intention to do so. In other words, in 1982, SEC adopted the rule 10b-18, which provided companies with a so-called safe harbor, or an exception, if you will, on the idea of potential criminal prosecution of market manipulation, or even civil prosecution of market manipulation, if they adhered to 4 principles or limitations. One is, you can't engage in the buybacks at the beginning or the end of the trading day. And I guess that's because that would have a greater impact on the market share of your stock. It would be there's a quality, I guess, of shock and awe. If one buyer comes in, buys up a 30%, 40%, 50% of the average of trading volume of your stock in one fell swoop at one point in the market, early in the day or at the end of the day. I guess that's the theory. You've got to use a single broker for the trades. In other words, you can't spread it all around to try and hide it. It's got to be a certain amount of transparency. If they purchase the shares at an existing or prevailing market price, in other words, you can't try and actually say, like, whoa, you're selling that stock for our stock for $25? We'll pay you $27. And you have to limit the volume of the buybacks to 25% of the average daily trading volume over the previous 4 weeks. So I don't know, if 10,000 shares of your stock trade every day on the past 4 weeks, one day it's 11,000, the next day it's 9,000, but the average is 10,000, you're allowed to buy back 2,500 shares. However, this has become a growing issue in the more progressive corners of the Senate. Bernie Sanders has been talking about this considerably. Senator Tammy Baldwin, Democrat from Wisconsin, sent a letter to SEC Chair Mary Jo White asking about the stock buybacks. And according to the letter sent back by the SEC, dated July 13th, Mary Jo White, the Security Exchange Commission chair, says the SEC doesn't collect the data that would let it know whether companies breach these 4 principles. Performing data analysis for issuer stock repurchases presents significant challenges, White writes, because detailed trading data regarding repurchases is not currently available. In other words, it's the honor system. It's trust and verify without the verify. And it's not just trust and verify without the verify. It's trust and verify without the verify, without any capacity to verify, even if we had some reason to believe that we should verify. This is going to become a larger issue. And William Lazonick, that aforementioned professor from the University of Massachusetts at Lowell, says the companies have that information, but the SEC doesn't collect it. Of course, the companies would have it, right? I mean, it is stunning. You have plans now put forth by Bernie Sanders, which is to end buybacks. No more buybacks. You can't collect the data on those parameters that are supposed to make it safe. Who cares? End buybacks. Then you don't have to worry about it at all. He's called for that in a Boston Globe editorial. Hillary Clinton has issued a policy paper which would basically vow to increase that disclosure by these companies. But as Lazonick says, the practice is the problem. Whether or not they're doing it within those parameters is secondary. The idea of stock buybacks basically is manipulation in and of itself, regardless of whether you try and mitigate the impact of that manipulation. And as you know, if you have listened to any of those interviews with Bill Lazonick, it is creating perverse incentives for CEOs and directors of corporations. And the result of the pursuit of those perverse incentives is creating massive wealth and income disparity between, well, 99% of us and that 1%. So that is something that hopefully as we move into the debate era of the Democratic Party, we'll hear more of. I don't know that we will, but I would like to. And it's certainly something I think we're going to hear more in the Senate.